Welcome to Pure Portfolio's October video market commentary. We've got a lot of great slides today. We've got a rate cut on the horizon. We're in the throes of earnings season. Many think this is a logic-defying rally. We're going to unpack what's worked, what we're concerned about, and hopefully this gives you a clearer picture of the macro and market backdrop. I know there's a lot of conflicting narratives out there. Folks are worried about various things, and hopefully this will help make some sense. Often a confusing data flow of information. So let's get into the graphs. As we usually start with, this is a snapshot of month to date through the 28th of October. So moving from the bottom, this red box, that's real estate, a basket of REITs, basically flat. And then short-term U.S. Treasury bonds with intermediate-term U.S. Treasury bonds. That's the gray and green, up modestly. Bitcoin's had a bit of a wild journey this month. It started out quite good, up about 12%, and then has pulled back some. Gold, kind of the same story, off to a good start this month and then pulled back some. That's part of that debasement trade, developed country debt, debasement of paper currencies. But still, all in all, gold is up on the month, and so is Bitcoin. And then you get into emerging markets, VWO, foreign stocks, think Greater Europe, Australia, Canada, VEA, a solid month as well. And then the S&P 500 leading the pack at about 3%. So all in all, a pretty good month. October is historically pretty volatile. However, when you zoom out and look at fourth quarters, this tends to be the best quarter in the calendar year. So certainly some seasonal tailwinds. If we can get through October, history would suggest returns for the rest of the year could be solid. We are about to embark on a rate cut, which has confounded some people. And when we look at the data, actually rate cuts near all-time highs, talking about the market, are more common than you'd think. So this kind of surprised us. And what we've done is highlight cuts within 2% of all-time highs for the S&P since 1980. So you can see percent away from ATH, that's all-time high, the day before the rate cut. And you can see the deeper the negative number, the further away we are from an all-time high, but they're all within 2%. And then we're charting returns following that rate cut for the next month, the next 3 months, the next 6 months, and the following year. Pretty powerful stuff here. Over the next 12 months, post rate cut within 2% of an all-time high, the S&P is positive 100% of the time with an average gain of about 14% or a median gain of about 11%. So not saying this happens in this instance, but two things. Rate cuts near all-time highs are quite common, more common than we thought. Performance for the following year tends to be quite good. Now, not every one of these cycles is the same, as we'll see as we get into the slides. We're trading at some of the richest levels the S&P has ever traded at, so future returns tend to be muted in that type of environment, so take this with a grain of salt. A lot of folks are baffled at what the market has done over the past 6 months coming out of the spring tariff disruption. Markets don't care who you voted for. Markets don't care about politics. Markets care about earnings, and earnings have been quite good. So this is a snapshot of earnings season thus far. We're about, I'd say, 60 to 70% through third quarter earnings. We've got some big tech companies on the docket this week. But thus far, of the companies that have reported, 80% have beat on earnings per share. 76% have beat on the revenue side, on the sales, on the top line. That's in the 96th percentile, meaning that's pretty darn good. That beats 96% of previous earnings quarters. Pretty powerful stuff. So a lot of folks, again, are confounded. They're watching the news. They're mixing investing and politics, and they're very confused about what's happening. Look no further than this chart. Earnings matter. That's what markets obsess about. Earnings have been quite good. Let's revisit a chart I've shared in the past. It's been a few months. So many folks are equating the AI movement with the internet boom. So what we've done is chart the NASDAQ's performance. The NASDAQ is a tech-heavy index. For the Netscape, for the internet boom back in the mid-90s, that's the blue line. So that's what the NASDAQ has done when Netscape launched in December of 1994. And then we have the AI launch in the fall of 2022, and that's the red line. And you can see, this is kind of spooky. AI, the internet boom, through 728 days since chat launched, Chat GPT was the first language model that launched back in the fall of 2022. Through 728 days, these two lines are tracking very closely. And if you believe this continues, you can see there's more good times ahead. However, you'll see some nasty dips here. And you'll also, the chart kind of cuts off, but this is on the doorstep where my mouse is, the top right of the graph. Maybe you can't see my mouse, but the top right of the graph, this is on the doorstep of the tech bubble. And if this graph were to keep going, this line basically moves straight down. I believe the NASDAQ lost 70 or 75% during the tech bust. So what this is telling me, sure, AI could have legs. Sure, AI is tracking with the internet boom, but there's going to be a period of creative destruction. Right now, AI is trading as if everybody who's involved in AI, from infrastructure to data models, is going to be a winner. There's going to be winners and losers. The market is rewarding everybody that's involved right now. At some point, the losers and winners are going to separate, and then you're going to see some creative destruction, which could result in a pretty violent pullback. So let's look at how far we've come since the start of the bull market in the fall of 2022. So back to 2022, if you recall, higher rates, higher inflation, that was bad for all asset classes. That was a very difficult year for investors. Since that point, from October of 22 to October of 25, we've been in a 3-year bull market. So the bottom axis, this is every S&P 500 sector, and the blue bar is price to earnings back in 2022. And you'll notice most of the blue bars are below the gray bars, and I'll explain what the gray bars are. And we're not going to get into the actual numbers, but know that the lower the number here in the vertical axis, the cheaper that sector is. So it doesn't take a rocket scientist to see that at the start of the bull market, virtually every S&P 500 sector was cheaper from a price to earnings standpoint. Fast forward to last Friday's close. We're tracking the price to earnings ratio of every S&P 500 sector 3 years later. And you can see overwhelmingly, most of these gray bars are quite a bit higher than they were back in 2022. Look at technology and real estate. Also look at the S&P 500. Okay, so technology has exploded on the back of this AI theme. This is more of a earnings and price story. So price has gone up for big tech, earnings have followed. Real estate's a bit different. Price has kind of stayed there. Earnings have really deteriorated. But looking at the S&P, looking at tech, and of course, technology is a big chunk of the S&P 500. These are trading at quite frothy levels relative to where we started the bull market back in 2022. You might ask, why does that matter? This is kind of the same type of look, but we're looking at percentile of past decades range. So how this would read, again, S&P and sector price to earnings ratios, percentile of the past decade. So the higher this number, so let's just look at the S&P, that means the S&P's richer than all but 6.9% of historical readings. Said another way, the S&P is richer than 93% of previous readings over the past 10 years. So that's great. The S&P's been on a great run. This has been the golden decade for investors. History could suggest, we'll show this in a minute, that future returns could be lower given how far that we've come. So this is a look at from starting levels of cyclically adjusted price to earnings ratio. So I won't dig into that, but know that the higher the CAPE, so cyclically adjusted price to earnings ratio, CAPE is short for that. That basically looks at 10 years of earnings and looks at the price relative to those earnings. So it's a way of smoothing things out. Earnings can be noisy, so we want to look at not 1 year, but 10 years. And the higher the CAPE, the higher our starting point, the lower future returns are. Conversely, the lower the CAPE, think a difficult market, think 2022, think 2009, when markets are depressed, markets are cheaper and future returns are better. So this is median 5-year real total stock returns by buckets of starting PE and starting CAPE. And there's a common theme here. The cheaper we are to start, the higher the future returns. Okay, so this first graph, this is dirt cheap, a CAPE of less than 11, a PE of less than 9. The vertical axis is future returns, future 5-year annualized returns. You can see this is the highest bar. On the other end, when PE, when CAPE ratio, based on the right graph, are above 19, that's the lowest bar. That means future returns are the least. Right now, just to give you some context on the far right, the CAPE ratio is hovering around 25 or 26, so well over 19, which means future returns could hover between 0 and 2% for the next 5 years. Now, a caveat here is just because something is expensive doesn't mean it's due to reverse. Markets have been technically overvalued for 7 or 8 years, okay? So this is a lousy timing tool, but over a longer period of time, starting point matters. Where you're currently trading at matters. And the S&P, by any historical metric, PE, CAPE, price to sales, price to GDP, relative to other equity asset classes, is historically expensive. So I can confidently say, I don't know when, but based on history, future returns could be lower for the S&P 500. And that's not a hot take. Virtually every large bank, every economist, every investment analyst is saying where we're at probably is not sustainable and future returns could be lower. So looking at lost decades. So just to give you an example, from 2000, after the tech bubble burst, to 2009, 2010, the S&P 500 returned 0%. They call that a lost decade. So any 10-year period where market returns are essentially flat, investors call that a lost decade. So what we've done is highlight lost decades for the 60-40 portfolio. And lost decades are more common than people think. Now, coming out of a period, again, this has been the golden age for U.S. investors. Most people aren't thinking about a lost decade. They're trying to squeeze every ounce of performance out of their investment portfolio. We might caution against that. But looking at these gray bars, this highlights 60-40, which would be 60% equities, so 60% S&P, 40% bonds, in periods where returns have been right around 0. And you can see we've had several of these instances over the past 125 years. The most recent, again, was 2000 to 2009, where a 60-40 portfolio actually achieved an annualized return of negative 1.6%. Okay? You might ask, well, what triggers this? What triggers it is our high starting point. So it's usually triggered by frothy values of stocks or bonds. In this case, this is where we're at right now in the cycle for a 60-40 portfolio. And again, U.S. stocks are trading at some of the most frothy levels that they have over the past 80 years, which means, I'm not saying a lost decade is on the doorstep, which means investors would do well to look outside of the S&P 500 in big tech. And this is one theme that we've talked about really for 3 to 4 years or so. It's starting to play out this year. So this is the U.S. versus international stocks. And this goes back to 2006. When the green line is going down, that means when the green line is going down, that means foreign stocks are outperforming U.S. stocks. And when the blue line is going up, blue bars are going up, that means U.S. stocks are outperforming foreign stocks. And you can see the green line is going down. Foreign stocks have absolutely crushed U.S. stocks this year. Not a lot of people are talking about that. If this graph went back from 2000 to 2009, the green bars would all be going down. So again, we're not saying this is the start of foreign stock outperformance for the next decade, but it's not uncommon for that baton to get passed from what's worked, which is U.S. stocks, to what's not worked, which is foreign stocks. And I always bring this up because every prospective client portfolio that we look at is massively and I can't understate massively, over-allocated U.S. stocks. They'll own the S&P, they'll own the NASDAQ, and they'll own the 7 biggest tech companies outright. That's a triple exposure that most people don't know that they're taking. And if and when U.S. stocks start to trail or we get a bear market, that's really going to hurt. So it's important to balance things out. And in our opinion, most other equity asset classes have a more favorable setup from a risk return standpoint versus U.S. large cap stocks. Now let's get into earnings calls. As I mentioned, we're in the throes of third quarter earnings. We actually track what CEOs and CFOs say on some of these earnings calls. So this is a snapshot of AI identified earnings call mentions of tariffs. So AI is scrubbing CEOs and CFOs talking, and we're capturing the number of instances in which they mention tariffs. And to no one's surprise, in the spring, these mentions were through the roof. So far through this recent earnings seasons, mentions have been a fraction of what they were back in the spring. So most folks, most investors, CEOs and CFOs included, have kind of accepted tariffs. They put them on the back burner. Most have found a way to navigate around them. This is the same AI identified earnings call mentions of job cuts and economic slowdown. So we're tracking what CEOs and CFOs are saying about a potential recession, job cuts, so on and so forth. And you can see so far through this earnings season, there's been about 59 mentions versus previous September. So going back to each September, you can see these mentions were much higher going back to 2022. So not that CEOs and CFOs think everything is all clear, but they're less worried about tariffs, less worried about the macro background, which could be a good thing. And that's something that we'll continue to track that you won't see on the front page of the newspaper. So that's it. Short and sweet. It's been good. October's been good. 2025 has defied a lot of investor expectations. We would advise not chasing here. Understand where the risk is in your portfolio. Don't get over allocated to some of these hot themes outside of your comfort zone. I'm always cautious when investing seems easy. Most investors would do well to diversify, to rebalance, just to be mindful of your potential range of outcomes. If you're curious about how Pure Portfolio strips emotion out of the investment process, if you want to learn more about our rules-based framework, shoot us a note at insight@pureportfolios.com. Thanks for watching. We'll see you next month.